Time now for our Muni moment, and our next guest says that Muni funds are well positioned to attract new money as the Fed gets closer to peak rates. Joining us now, I'm pleased to say, is Jason Appleson. He is head of the municipal bond team over at PGIM Fixed Income. And let's talk about that. Is that the bull case for Munis here?
Well, thanks for having me on the show. Yeah, I would say we are cautiously optimistic about Munis this year. You know, if you look back over the last 40 years, every time there's been a big down year, it's been followed by exceptional returns the following year. And we're through the first half of this year, and I wouldn't classify these returns at just over 2.5% as exceptional, and they've really been constrained by fund flows. And fund flows are really a function of the headlines that we're seeing throughout the first half of the year. And those include the Fed rate hiking cycle, the debt ceiling, and of course small bank failures, which as retail investors read those headlines, they're really reticent to put money back into municipal bond funds.
But the headline for the second half is going to be further slowdown in the economy, possible recession. We're going to see all the impact from the year's worth of interest rate increases start to show up in the economy. Is the narrative going to be different in the second half that would lead to better returns for munis?
I think so. With these constraints removed, again, think back to the debt ceiling resolved the end of May. The Fed paused, indicating that they have to review how their policy has affected the economy. And of course, the selling from banks, including the SVB municipal bond portfolio, really concluded last month. So with these obstacles out of the way, I'd say there's a lot more ability for municipal funds to attract demand. And fund flows are highly correlated to performance in our market, given we're so retail dominated.
I want to talk a little bit more about that last point, because you also write in your notes the community banking crisis that began in March of this year left a cloud over munis, like you mentioned, that forced selling. Where are we now? Is it safe to say we're really past the worst of that, or could there be more to come?
So I never want to say we couldn't see more, but a lot of what we've seen, the selling from the FDIC when they took over these community banks, including SVB's $7 billion municipal bond portfolio, they were dripping that out into the market over the last several months, but finally that process has concluded. So unless there are any new surprises, which I won't say there won't be, we don't expect to see that kind of selling adding to the supply in our market.
Okay, the other big theme in muni land right now is the lack of supply, the anemic new supply. And it's usual around this time of the year, but I think this year is particularly noticeable. What are you doing to combat that? How do you get through this?
Yeah, supply has been very anemic this year. It's been down about 20% from last year, which of course was down from the year before it. What you really have is you have more dollars chasing fewer bonds. And one way to do it is stay more fully invested as you move through the year. It's really important that you keep your cash invested in interesting securities. I would mention that, bottom-up security analysis, credit research, that's what we do at PGIM Fixed Income. That's been incredibly important to pick out good opportunities if you're a more flexible investment manager rather than a passive investment manager that kind of just owns the market.
Those are the conversations around munis that I love to have when we start talking at the state level. So when you're doing that bottoms-up analysis, where looks like an opportunity right now when you look at the map of the U.S.?
Yeah, so there are a couple sectors that we really like in here. I'd point to charter schools, which are, we talked about a slowing economy. Generally, states and local governments support their schools even through a slowing economy. We have things like serial tobacco bonds, which could withstand and absorb large amounts of cigarette consumption, which tend to do very well. And plus, they're bolstered by this inflation premium that gets attached to the calculation of payments of tobacco bonds. Things like that. We like prepaid gas, which are backed by money center banks. Think Citigroup, Morgan Stanley, Goldman Sachs. They're much more diversified, better regulated. They're fresh off of a stress test too. So we really like those. They look a lot better than they did pre-2008.